Hey everyone, thanks for joining this video. In today's video, I'm going to be talking about 4 Canadian dividend stocks that I'll be buying throughout the month of October 2023. These are some of the best performing videos that I get on the channel. Lots of engagement, comments, and tends to get lots of views. So I want to thank you guys in advance for your time on this one. If you like this kind of content, be sure to give me a big thumbs up at the bottom of this video. It really does help get these videos out to more people. And with that, I will jump into it. So the first Canadian dividend stock I will be buying in the month of October 2023 is Canadian National Railway. You see here on the stock, it's down 2% on the day here, but it's really trended down over the last couple months, down 6 to 7% in the last 6 months, down about 5% in the last 1 month, currently sitting at about a $95 billion value, and they have a dividend yield of about 2.2% that they increase every single year. Going into their business a bit more here, you can see their financial metrics here. So their revenues have been growing at a 5% growth rate over the last 5 years, EPS slightly outpacing that at 6%, net income only 4%. So the delta here is really the shares that they've been buying back. Some of their operating metrics, volume's been about flat. EPS up 8% there. Free cash flow growing really, really nicely, especially that 2022 number of about $4.3 billion. In terms of their network, and some of the great things about railway businesses to start is no one is really building new railway tracks in North America, right? So I think there's about 7 top railways in North America that have unique tracks, gets across the continent in a good fashion, and all of them are unique one way or another. But they really don't have any new emerging competition. Their competitors are really trucks, more trucks going on the roads, more cargo and airplanes and stuff like that. But rail, I believe, is just the most efficient way of moving goods around the country. And in lots of these regions, it's the only option. Out east in Canada or out west in Canada, lots of farmers literally do not have another option to ship the types of products that they're shipping. So you can see the network here in terms of the size of business, where that business is coming from here. The overall network goes from the west of Canada to the east of Canada, and then right down through the United States as well. You can see lots of their businesses done in trans-border, volume going into the US, some volume going up into Canada, tons of volume on the western port of or the ports on the western side of Canada, with tonnage coming in and out of the continent in terms of exports, imports from other countries, and then those goods are then taken from ocean freights, put onto rail, and moved across the continent. So really unique business here, really hard to compete with this business, and they really are well positioned on the continent that has the best economy in the world. So really like all of those dynamics of this one. If you look at their revenue mix here by category, you'll see a lot of diversification as well, which I really like to see, and which is great. And then in terms of traffic density, you can see it's mostly populated on the west through to central Canada and northeast US, and then it kind of thins out east. They don't have as much of a presence, and then down to the US, they have less tracks and stuff like that going as you get more and more further south. So this is really the bulk of their business here. In terms of what's kind of been going on with CN Rail, what are some of the reasons why the company hasn't been doing as well lately? You can see here that they've had a bit of a decline in some of their main categories. So forest products, think like lumber, how crazy the lumber prices were and stuff like that, down year over year. It's a really interesting relationship between the price of commodities and the amount of volumes they tend to do. When, let's just use lumber as an example, when the price of lumber is high, it means the opportunity of cutting down more trees grows. So those companies make more investments to increase their volumes, and the more they increase their volumes, the more they need CN Rail services. It also becomes more price inelastic in terms of the rates to move that type of product. If they're making whatever, $100 a tree, or $1,000 per whatever metric ton of lumber that they benchmark against. The higher the price of the commodity being moved, the more inelastic the pricing model for CN Rail is, because a couple dollars out of $1,000 to move that product, or 10, 15, $20, it's not really material. But as the price of those commodities come down, they may stop investing in expanding how much volume that they can derive from their claims, and they may start thinking about the cost of transportation a bit more as something that is chewing into their margins, and look to slow down how much they're shipping out all at once or in one season, or stuff like that. So it's all those kinds of considerations in terms of prices of commodities. So forest products down. You can see some of these other products are kind of just meh, flat. Chemicals, petroleum, metals. Bulk, you have Western Canadian coal is up, and grain has been up. It's a really good grain yield this year. But fertilizers, US coal flat, and then intermodal, domestic and international. So think about just raw goods, like people buying products in their house, and people delivering or businesses delivering product to stores, stuff like that. Lots of that stuff is down in a really big way. Automotive is ticking up though, which is offsetting it a bit. But for the most part, the intermodal business has really been what's hurt the stock price and the outlook for this year. In terms of their expectation for the year, so they're expecting EPS to be about flat, which is really disappointing if you look at the long-term trajectory of this company. They've tended to grow their EPS at a really nice rate, high single digits into the double digits. And there was a lot of acceleration during the pandemic. So I think this is just a bit of a correction, normalization, and they should continue to grow, into the future with how fast the economy in the continent's growing. Plus, they price ahead of inflation typically. So they should still be able to grow. But I consider this to be a bit of a normalization year. Still increase the dividend 8%. They've increased the dividend every single year since becoming public in the mid-1990s. And I think their dividend CAGR is actually in the teens. So they don't just increase it, they increase it a good amount every year typically. And this company buys back tons of shares. You can only expand into new tracks, new ports, stuff like that to such a large extent. So they tend to repurchase lots of their shares for their common shareholders. 32 million shares is about 5% of the company this year. So that is actually a huge investment that they are undertaking with the capital on their balance sheet. You can see here lots of the share buybacks that they've done over the years. So since 2000, and let's pick a good date here. Since 2010, they had 930 million shares. 13 years later here, they've bought back a third of the company. They currently have 660 million shares today. And this just keeps going down every year. You can see how it's accelerated through 2022 as they kind of used all that cash flow they got through the pandemic, with intermodal being at really high levels, and buying back shares of the company to return that value to the shareholders. In terms of forward looking, you can see here next year they're expected to do about $8.26 a share, which puts their current share price at about 18 times next year's earnings. Now, interest rates are at really high levels, which is contracted price to earnings prices. But typically, Canadian National Railway trades in the 20 to 23, 24 range on price to earnings. So long-term speaking, this is, I believe, my biggest position in my overall portfolio. So it's one that I plan on holding for decades and decades, and I feel comfortable having a bigger stake in this company. I think it's going to be a really hard company to disrupt. They have a lot of different businesses, whether it's domestic, international, etc. So this is one that I think it's a good opportunity for me personally to get in at these lower price to earnings ratios, and the company's buying back tons of shares at this lower PE level, which hopefully yields strong returns and compounded returns in the future. You can see here, long term, the company's done really, really well in compounding their growth. So they've had a bit of a slump here, bit of a hold up, but I'm hoping that if I look at this 5-10 years from now, it'll continue going up and to the right, and I'll be really happy that I continued to buy shares during these more uncertain times in the economy. Going on to stock number 2, probably a much more contentious stock than CN Rail. It is Allied Properties REIT. So this is an office REIT primarily in Canada. You can see here the company's done terribly over the last year. Was at around $30 a share at the beginning of the year, down to $17, so down about 40% on the year. But this stock used to trade for $55, as you can see here, right before the pandemic. So down a good 70% to where they are right now, paying a 9.2% dividend yield. Let's go over this company a bit more. In terms of the types of assets that they own, you can get a sense from just me scrolling through these pictures. They own like flagship office assets is their bread and butter. Sure, they own about 10% of their business in retail. That's usually just floor level on their office buildings, and they own some multi-use with residential and stuff. But they're primarily an office retailer. Sorry, an office REIT, and you can see the types of offices here that they kind of put together and that they own. So usually pretty fancy offices in downtown cores, really good locations, really expensive real estate. One of the projects that they are partnered on with a few other REITs is the Well in Toronto, which is office, but also residential, some retail in there. So this is currently coming online right now. This is their overall footprint here. You see they have about $15 million of gross leasable space. Over 1/3 of that's in Toronto, 5.1 million in Toronto, and then almost 40% of it's in Montreal. So between Toronto and Montreal is about 70% of the company, give or take, maybe even 75. And then they have some presence in Vancouver, Calgary, Kitchener, Ottawa. And that's pretty much it. They're pretty focused on the cities they operate in. Within these cities, they tend to have very central locations. So you can see here, for those who may be familiar with Toronto, all the properties in downtown Toronto that they own. Everything on King Street here. So both sides of the street between King and Adelaide, they pretty much own half of the entire community. Really popular spot here. Lots of people love going out here, love working here, love living here. So really, really great properties to own. You can see even on the other side of King Street, they've expanded recently on the east side, or at least more recently, all of these dots that they own here. So just tons of presence in the downtown cores. They don't have like tertiary and secondary office buildings and rated real estate outside in the suburbs. They're really downtown focused because their whole value creation model is all about intensification in downtown core. So building up, knocking down 6 buildings in a row, building up a huge tower with tons of interlocking space inside, just to kind of intensify and build these downtown cores up for more people. Looking at some of their tenants, just so you can get a sense of where they play, very heavily tech focused, right? So they have Google, Shopify, Technicolor, Ubisoft, lots of these companies, 100% tech plays. Then they also have some other just big companies naturally, Morgan Stanley there, National Bank of Canada, Entertainment One has one of their offices in downtown Toronto, which is in a really good location as well. So this is kind of just a little look at their tenant mix. In terms of their funds from operation here, so you can see for the last 3 months, they made about 60 cents a share. In the last 6 months, they've made about $1.17. You can see it's about a 3% drag versus a year ago, but they're still expecting to do over $2.20 of funds from operations this year. When I go look back at what they were doing back when the stock price was over $50, it was literally about the same. So you're pretty much getting the same earnings for a stock that's trading, or equity that's trading 70% cheaper than it was. Okay, so at $2.20 a share, this one's trading at about 8 times earnings, or 8 times funds from operation for really core, really central real estate in Toronto, or Toronto, Montreal, big cities with big tenants like Google and stuff like that. So obviously, elephant in the room. Why is this happening? Lots of headwinds on office REITs and REITs in general. Interest rates going up is an immediate hurt to them, both because of the obvious higher cost to serve that debt. But in addition to that, lots of banks are rethinking how much office REIT exposure they want on their loan book. So the concern is as the loans come due, will they have a hard time getting banks to loan them out the money? Will they have to liquidate some assets to pay off those outstanding debts? Will they get higher interest rates or higher spreads charged to them on their revolving credit doors and so on and so forth? So that's just an overarching concern, and I'd say that's the main thing. But in addition to that, lots of rhetoric around how long working from home will remain a thing or if it will expand, and just people not coming to the office as much. Since they have such primary office space, super expensive office space, maybe less and less companies will be interested in renting that type of space from them, just given maybe lack of importance or diminishing importance of that physical premium space. So we'll see how it plays out. My personal thought is at almost a 10% dividend yield here. Actually, it is a 10% yield, $1.80 a share. The stock price is about $18. So at a 10% payout on an annual basis, trading 8 times funds from operation, which is pretty much saying the business right now is providing you a 13% give or take annual return. I do not think you can go out and buy real estate in downtown Toronto, no matter what type of real estate, for anywhere close to a 13% return, nonetheless a 10% dividend yield or anything like that. So I agree that these headwinds should be pricing REITs like this down. I just think they've gone down way too much, down 75% on the equity for a really well diversified REIT across tons of major cities with relatively high occupancy rates, paying out a 10% dividend. So they've continued to increase the dividend year over year. I believe I have that here as well, that you can see. They have a really good track record as well, increasing the dividend a few percent with inflation every year, including this last year, even after the company was coming under pressure. They said our free cash flow is still good enough to pay this out. So I just think that they have a great history, great portfolio in great places. Sure, there's macro headwinds with what we were just talking about, interest rates as well as office occupancy. But I think that overall, it's a decent risk reward, even though more risky than most of the stocks I invest in. I can see this one going back up to $30 and trading just 50% of what the net asset value is very easily. And that would look like almost 100% return. So not one I'm going extremely heavy in, but given the prices, I am looking to add some more exposure to Allied and kind of capture that dividend month to month while I wait for it to hopefully rebound. Going into the third stock, it is Pizza Pizza Royalty Corp. So I'm looking to continue to add to Pizza Pizza. This is a stock I've owned for a while. I've done actually pretty well with it, as you can see here over the last 5 years. Up 40%. They also pay a nice dividend yield. But I actually have not bought fresh shares of Pizza Pizza for years now, since before the pandemic. So I'm actually looking at building this position out a bit. Really like their business. Think they're really starting to get back on a good trajectory as well. You can kind of get a sense of their restaurant growth. So it's a bit volatile, but overall they increase their restaurant presence by a few percent every year. Primarily a pizza traditional business, which is you just go into a pizza on the corner. That's about 500 locations. 200 locations are unconventional. So think of these locations as ones that are in sporting arenas or stuff like that. And then about 100 of them are Pizza 73s, which are in Pizza 73s are in Calgary or Alberta for the most part. It's a different franchise that they have there. Going into just their distributions, the blessing and the curse with these royalty funds are you literally get 100% of the earnings of the company. So every time earnings go up in terms of revenues, you're getting that higher payment by 2 or 3% on the dividend. But adversely, as you see here, when payments go down, same thing happens. They don't have cash reserves like other companies. You're genuinely just getting what the company's bringing in. So I kind of like that, because as same-store sales growth tend to go up, you tend to get some inflationary growth with the dividend on a starting dividend that's already pretty good here at 6.6%. But I just wanted to show people who may be a bit less familiar with these royalty funds what that equates to overall. It's just a bit less predictable and steady, and it really just goes with what sales tend to perform at. And then lastly, you saw the big dip that they had during the pandemic. They've really been steadily increasing their dividend, increased the dividend 7 times in the last few years to get it back up to what it was pre-pandemic, which was great to see as well, that they've kind of fully recovered from that time. Okay, going into the fourth Canadian dividend stock I'm buying, and I'll try to go through this one quick because I think it was on my last month's as well. But I'm still buying more Jamieson Wellness here, down 25% in the last year, down another 5% here in the last month. So Jamieson, just going over some of their highlights here. Despite the stock price going down 25-30% in the last year, they actually increased their dividend to 19 cents per quarter from 17 cents. So that's an over 10% increase in the dividend. That was a nice little credibility or confirmation that the leadership group there is confident with how things are going. U-Theory, which was one of their acquisitions from last year, met revenue expectations, and they're planning some new product launches there. And they continue to have solid consumption and growth in Canada. So they're saying consumption outpaced shipments. So as we look at what shipments were, you can see revenue was just 2% growth. What they're saying is there was an inventory correction at some of their retailers like Walmart, Costco, etc. So the business health is actually much more healthy than 2% growth. This is just what they realized in the quarter. So that stuff kind of balances quarter to quarter. We'll see what it ends up on the fiscal year total. Some other things here. U-Theory, really strong contributor to the overall company here, which is great to see that acquisition get kind of digested by the company. China revenues up really nicely, and then international revenue, which is more licensed revenue, I believe, that they just have wholesalers and stuff. Less strategic part of their business. They talk a lot about Canada being like the cash cow currently, and then the US and China is really where they're expanding. They don't touch on international too much, so not surprised to see it maybe less of a focus, or fourth on the list, let's call it. Just looking at this company overall, their target is almost $700 million in revenue for 2023. They want to do about $1.60 in EPS is their updated target. So looking back at their share price here, $700 million of revenue, they're trading for $1 billion right now. So about a 1.5 times revenue multiple on this company here. When I go to other more established CPG companies, it's like a 3 or a 4 times multiple. Then the price to earnings ratio, if they do $1.60, they're about a 15-16 times earnings versus their current price at $25. And lots of the other CPG companies, whether it's Pepsi, Coke, you name it, they're all trading 25, 26 times. So this is cheaper on price to earnings, cheaper on a revenue multiple, probably in a bigger growth category than lots of those other businesses. And as a Canadian sitting investor, I get the benefits of not needing to deal with FX, not having to deal with extra taxes from holding or gaining US income and everything else. So I think the valuation is really attractive given their long-term history on this company. And I like the fact that it's a bit of a smaller company, lots of room to grow. US is pretty much untapped for the Jamieson brand, growing really fast in China, and a really solid developed business in Canada to just kind of like level things off and back things up, pay the 3% dividend for me. And I expect that dividend to grow year over year like they've done the last 6 years in a row. So this is one, still a really small position, but looking to build it up, make it into at least a normal size position for me over the month of October. So those are the 4 stocks I'm buying in October. Let me know what stocks you're buying in October or looking at buying in October in the comment section below. Thank you guys so much for watching if you got all the way to the end. Would really appreciate it if you hit that thumbs up button, drop a comment below saying hi. Also, would love if you subscribe to the channel if you haven't already. See you guys in the next one.